We're joined now by Calvin Schnure. He's a senior vice president at Nareit. And Calvin, we were just talking about the fact that the Fed doesn't like to call its its asset purchases at this point QE. Does that matter to you? Is that something? I mean, is it QE? What is it from your perspective?
No, the purchases they've done over the past several months have been strictly a technical matter aimed at making sure that there are enough reserves in the system for the banking system and the payment systems to function smoothly. It's not affecting long-term rates. It's not affecting overall liquidity in the market. These purchases of Treasury bills are not a monetary policy action. It's a technical adjustment for smooth functioning.
So let's get to the base of why they're doing it, because they've never really explained why it was necessary. There are rumblings within the industry that there might be a bank out there, perhaps a European bank, that could be in some kind of difficulty. Do we know more than, we misunderstood what we were doing when we were tightening, why they needed this repo situation?
You know, most people don't realize how difficult the challenge is for making sure that you have smooth conditions in overnight rates, because it's a very important market. And for a long time, the Fed managed it very closely because you did not have a lot of excess reserves. But after the financial crisis, when the quantitative ease brought in a large number of excess reserves in the market, you had a much smoother condition, and the Fed did not need to worry about managing the day-to-day and week-to-week volatility. Well, over the past year or so, that has changed. There are fewer excess reserves. And then you had some things like the federal tax payment that came up a couple months ago that caused some spikes in volatility in the rates. The Fed had said for quite a while, we don't know when we'll get to the point where we need to manage these reserves more closely, but when we do, we will adjust. And what they're doing now is they're adjusting. They're making sure this is smooth operations.
Calvin, what do you think the Fed sees as the biggest risk to its current policy stance right now?
The biggest risk is probably not something that's near term, but in longer term, that they just don't have the scope to give a lot of monetary stimulus in the next recession. We don't see a recession in the near future. I don't think the Fed does either. But typically, when the economy would go into recession, you'd see the Fed cut interest rates by 400 basis points, 500 basis points or more. They simply don't have room to do that right now. And in a low inflation environment, you know, their monetary policy stance is perfectly appropriate right now. And I think everyone's hoping that we have smooth sailing for several years ahead so that the economy can get back into a more normal price dynamic.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.